So now we take each type of stakeholder in turn and analyze them more carefully. So we look first at the shareholders and the firm. Firms are characterized by what we call principal-agent conflicts, corresponding here to the shareholder-manager relationship. This arises from the separation of ownership and control, where the providers of capital pass the day-to-day management of the firm to expert managers. In theory, the shareholders should exert significant control over management through the market for corporate control, which disciplines managers to achieve shareholders' interests, or otherwise they risk their position through hostile takeovers of an underperforming firm. Therefore, they will lose their job. Also, through the market for managerial talent, which involves incentive compensations in the form of stock options and performance-related pay. And they can control the managers by actively monitoring them through the firm's board of directors and the firm's annual meetings, but also through institutional and block shareholders, and indirectly through banks and other debt holders. In practice, however, none of these mechanisms are as effective in disciplining management as theory suggests. When managers don't act in the best interest of shareholders, the firm incurs agency costs. These are some examples of agency costs. Things like excessive consumptions of perquisites, earnings manipulations, excessive diversification, or issuing less debt than optimal. Such behavior may or may not be illegal, but it is rational. Like all of us, managers are self-interest individuals that make decisions for their own benefit sometimes. Ultimately, how shareholders and other stakeholders control or try to control management is complex and relates to broader issues of corporate governance. For example, in the Anglo-American model, dominant mostly in the US, UK, and Australia, corporate governance emphasizes a well-developed and regulated stock market, strong investor protection, and substantial disclosure and reporting. In contrast, the German-Japan model, prevalent in Germany and continental Europe, Japan, and other parts of Asia, assigns a greater role to long-term manager-investor and firm-bank relationships, concentrated ownership, and cross-shareholdings among firms and between firms and financial institutions. Yet, in other countries like China, shareholders provide capital but may have little control on the management action. Now let's look at bondholders and the firm relationship. In theory, there is no conflict of interest between shareholders or the firm and bondholders. There is an incentive for the firm to appropriate wealth from bondholders, but not to the extent that it would reduce the value of the firm. In practice, shareholders and bondholders have different objectives regarding the firm. Bondholders are concerned most about safety and avoiding risk and ensuring that they get their money back. They do not benefit if the firm significantly increases its value because their claims are fixed, do not change. On the other hand, shareholders are more likely to think about upside potential. It is only when the value of the assets exceeds the value of the liabilities do they obtain value. As the firm is owned by shareholders, management and the board are acting in shareholders' interest if they attempt to benefit from the expense of debt holders. They are just doing their job. Examples of such actions are when managers increase dividends significantly. When firm pay cash out as dividend, lenders to the firm are worried because the firm becomes riskier without enough cash to pay debt obligations. taking riskier projects than those agreed to at the beginning of the contract. Lenders base interest rates on their perceptions of how risky a firm's investments are. If stockholders then take on riskier investments, lenders will be hurt because they haven't incorporated a sufficiently high level of risk in their decisions about lending money to the firm. And also through excessive borrowing, meaning that cash flow needed to service the debt or assets to cover the debt in event of liquidation may be insufficient. Because debt holders have no say in the day-to-day running of the firm, they attempt to control this behavior early by using covenants and other controls set in place before financing. Now let's look at the financial markets and the firm. In theory, financial markets are efficient. Managers convey information honestly and in a timely manner to financial markets, and financial markets make rational judgments of the effects of this information on the true value of the firm. As a consequence, a company that invests in good long-term projects will be rewarded if the markets are efficient. Short-term creative accounting will not lead to an increase in market value. And stock price performance will be a good measure of company performance. However, in practice, markets are not fully efficient. This is because the market doesn't always get it right. The information, especially negative information, is sometimes blocked or delayed by managers seeking a better time to release it. In some cases, firms release intentionally misleading information about their current conditions and future prospects to the markets. In reality, prices are much more volatile than justified by the underlying fundamentals. And financial markets overreact to news, both good and bad. Also, they are manipulated by insiders in such a way that ultimately prices do not have any relationship to the value. And markets are also short-sighted and do not consider the long-term implications of actions taken by the firm. And lastly, we look at the society and the firm. In theory, all costs and benefits associated with a firm's decisions can be traced back to the firm. Firms typically internalize these costs or benefit in the firm so that it is accounted for through taxes and subsidies. However, in practice, financial decisions can create social costs and benefits, which we call them externalities. Examples of such social costs are environmental costs like pollution, health costs, and quality of life costs like traffic, housing, and safety costs. On the other hand, examples of social benefits are creating employment opportunities, supporting infrastructure development, and creating access to goods in areas where such access does not exist. Unfortunately, social costs and benefits are difficult to quantify because they might not be known at the time of the decision. In other words, a firm may think that it is delivering a good product that enhances society at the time the product is launched, but discover afterwards that these products are making a very large cost to the society. Think about asbestos, tobacco and alcohol, and very many others. Also, costs are difficult to quantify because they are person-specific. That is, the decision makers weigh them differently. So to recap, the traditional corporate finance theory breaks down where there is a conflict of interest between managers and shareholders, when the lenders are not protected and are taken advantage of, and when financial markets are inefficient, and when significant social costs are created that cannot be traced to the firm. The solution then becomes to find a different mechanism for corporate governance, perhaps adopt certain policy that ensures ethical behavior and less agency costs. Also, to find a different objective to the firm, one that reduces the potential conflict between the firm and its stakeholders. The shareholders have provided a counter-reaction. Institutional investors have become much more active in monitoring companies that they invest in, and nowadays are demanding changes in the way in which business is done. At annual meetings, shareholders have taken to expressing their displeasure with the current management by voting against their compensation contracts or their board of directors. Since the global financial crisis, firms have been subject to strict regulations on executive remuneration. However, you cannot legislate good corporate governance in the end, and sometimes the costs of meeting legal requirements exceed the benefits. In general, laws tend to penalize good companies more than they punish the bad companies. In the context of our discussion, managers taking advantage of shareholders has led to a much more active market for corporate control. For example, if they don't perform, the managers will be put on notice. The shareholders taking advantage of bondholders has led to bondholders better protecting themselves at the time of the issue. Firms revealing incorrect or delayed information to markets has led to markets becoming more skeptical and punitive. As investors' access to information improve, it is becoming much more difficult for firms to control when and how information gets out to the markets. When firms mislead the markets, the punishment is not only quick but is savage. While firms creating social costs has led to more regulation, as well as investor and customer backlashes. If firms consistently create larger social costs, the government response will be to pass more laws and regulations against such behavior. Finally, investors may choose not to invest in companies that they view as socially irresponsible. This is some evidence of how stakeholders affect a firm's objective. For example, in the banking industry, there are some benefits, such as innovative low-cost financial products and services, efficient and technologically advanced, well-performing sector, which is heavily regulated. However, there are some costs too, whether they are real or perceived, such as being criticized when raising mortgage rates excessively, being profit-focused and insensitive to customers, condemned for closing branches and charging high fees, and considered to be a male-dominated employment environment. This is an example of how one bank has responded to corporate governance issues. ANZ has consulted with their stakeholders and acknowledged their role in the society and community, and focusing on responsible practices, education, helping low-income families, provide banking in rural areas, and engage in sustainable practices. In their annual report, they present non-financial performance that refer to corporate governance, such as customer satisfaction, women in management, investment in the community, and again, sustainable practices. In a different sector like mining, the benefits are in the form of being a major export earner and employer, contributor to the public revenue through taxes, and sponsorship of community events. The costs are in the form of pollution, infrastructure pressure, inflationary influences on economy, working with corrupt governments and countries with poor human rights records. And this is BHP's response to all those issues. By following these principles, they are committed to address the issues of human rights, labor, environment, and anti-corruption, as well as ethical and sustainable practices, community-focused activities, and engage in transparent communication and reporting with its shareholders. This concludes Module 1.